What usually happens in a bull market? People make money. Yes, but only if people are invested in that market. You see, for every person who makes money in a bull market, there are dozens of others who either sat on the sidelines or waited too late and missed their opportunity. Now, all signs point to a bull market taking place sometime next year. As long as we can get inflation under control, which it does seem to be working, and as long as we avoid a major recession. So as long as we can avoid those two things, the market in general seems primed for a bull run. So how do you make sure that you are not on the sidelines? How do you make sure that you are exposed properly to the market? And how do you make sure that you use these periods that come every few years to better your financial situation? That is exactly what I want to talk about in this video. I want to talk about how to invest, what I would invest personally in, where to keep your money if you're keeping it on the sidelines for that like perfect moment. Even then you can be making a return if you use the proper assets that are at your disposal. You don't have to have connections. These are available to pretty much every person, at least in the United States and really in the entire world. So let's talk about exactly that. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's talk about positioning yourself properly to make money in the most likely scenario for 2024, which is most likely a bull run. So first and foremost, before everything else, if you want to make money in a bull run, you have to invest in the market. So if you are brand spanking new to investing and to personal finance and to bettering your financial future, I would definitely check out my video that I just filmed last week on that exact subject, which is how to invest your first $1,000. That's a great video for beginners, and I would refer you to that if you are a beginner. For everyone else, and of course beginners as well, make sure to finish this video because there's a lot of good information here before checking that one out. But for everyone who wants to make money in the bull run, I guess there are two camps, right? There are the camp of people who 99% of you will fall into that camp, and that is everyday investors, right? People like you, people like me who are investing our personal money and want to make a return, but we also don't want to lose the barn in a sense. We want to protect ourselves from downside risk. Then there are those who are more active in their investments and they are more active in picking and choosing exactly what they're going to go into and exactly where they're going to position their money. Those people usually make more money, especially in bull runs. The problem is, if for whatever reason we do not have a bull run in 2024, those are the people who are going to be hurt more. So it really comes down to what's known as risk tolerance and your personal risk tolerance. You see, everyone's personal risk tolerance is going to be different. Mine is going to be different from yours because we are different age, we have different living circumstances, we make different amounts of money, we have different years of experience. There's a whole myriad of things that can make your risk tolerance different than mine. You might be close to retirement, you might be far away from retirement, you might be older than me or younger than me. All these things matter. So first and foremost, you need to ask yourself, do you want a set it and forget it strategy, right? Where if a bull run does come, you're going to make good money. But in the event that a bull run does not come, you are not going to lose the barn, in a sense. So you need to ask yourself first and foremost if you fit in that camp or if you're more of a risk taker and you want to potentially pick and choose individual stocks or to pick and choose a portfolio of a dozen or 2 dozen individual stocks, because your outcome in 2024 will be different. Not only that, you can fall somewhere in the middle where you can have a majority of your portfolio in more diversified assets, and you can have a few $1,000 or a few percentage points of your portfolio in hand-selected stocks. There is no right or wrong answer, and truly the only person who will know what, when it comes to that, what the best positioning for themselves are is you. So you need to ask yourself, and of course you need to have a general understanding of finance, and you need to make that decision for yourself because your outcome will be different. So let's break down these two camps. Camp number one is the well-diversified portfolio crowd who will make returns in a bull run, but they might not go from zero to millionaire. Right? So let's start with that because I think that's the majority of us. I think the majority of us want to make good money in a bull run. We want to take advantage of that bull run, but we want to have downside protection. For these people, first and foremost, you must be invested in the market. Second, you must utilize ETFs to your advantage. All right? The power of ETFs is that you are still going to get exposure to the market, and during a bull run, these ETFs can double just like stocks, okay? A good example is if you go look at the chart for VGT, right? VGT is a very tech-heavy ETF, and during the most recent downside of the market, it did crash significantly. Okay, for those of us that fall into the camp of of buy when there's blood on the streets, for all those people, made money, a lot of money during that move. And this is an ETF that tracks the tech sector. So there are ETFs out there that will give you outsized returns in good scenarios. All right, so just be aware of that. They can move significant amounts just like stocks. The power of ETFs comes in downside protection. If there is no bull run, or in a worst case scenario, we have a recession instead, because remember, I can speak from my experience. I do have my degree in finance, and I can speak from my over a decade of doing this myself. The fact of the matter is, I do not have a crystal ball. Nobody does. So nobody knows exactly what's going to take place in 2024. So the power of an ETF is, while we can make educated predictions and educated guesses and presumptions, not assumptions, about the market, we still allow ourselves some margin for error. So an ETF will protect you from downside risk precisely because it is not a singular stock, and most ETFs are rotating in nature. What I mean by that is, for example, if you track the S&P 500, those are the 500 largest companies in the United States, right? And ETFs that track the S&P 500 basically mirror its movement. If one stock or two stocks or five stocks in the S&P 500 go bust, the S&P 500 in itself does not go away. So that is the power of an ETF that tracks something like a broad market index. And it's same with individual industry ETFs as well. You are tracking a basket of stocks, and you are getting exposure to a basket of stocks. So if one or two or five just completely go belly up, you are not going to lose the barn. You will feel pain just like anybody else in a down market, but you will not lose the barn compared to someone who hand selected a few stocks. If you hand select a few stocks and a good number of them do poorly, or in a worst case scenario go defunct, you're fucked. Okay, so you got to remember that. So that is the power of ETFs, and they can still move significant amounts, and they can still make you a lot of money. All right, so looking specifically to 2024, a lot of people are calling for one of two scenarios, either a recession or a bull run. I personally fall into the camp of, I think that we're going to do okay in 2024, and I think that there will be a bull run, truly. Now, can I be wrong? Absolutely. But if we look at that, what is the main thing that we need to do? We need to be invested in, first and foremost, something that tracks the S&P 500 as a whole. Okay, this should be the bulk of pretty much anyone's portfolio who's investing in the market. Something like the VOO, all right, or the SPY, something that tracks the general market. Now, we also have to ask ourselves, in bull runs, okay, what type of company does well? All right, so there are companies that do well in different market environments, okay? When interest rates are low and money is cheap and there's a bull run on the horizon, which companies tend to do well? Well, the companies that benefit from that, which are usually tech companies or progressive thinking, new technology type companies. So we're talking the Amazon, basically FANG stocks, right? The Amazon, the Netflixes, the Facebooks of the world, because they're tech centered and they rely on a steady stream of cash to be able to grow. So looking at the environment that we are currently in and trying our best to project that into 2024, if we can get inflation under control and if we can avoid major recession, what is most likely to happen with interest rates first and foremost? Well, the Fed is keeping interest rates high, and at the last meeting raised interest rates to fight inflation. So moving into the later half of 2023, if we can get inflation down to the level that the Fed wants, which is a target rate of 2%, or if we can at least get close, maybe in 2024 the Fed can start reversing course. If the Fed reverses course, okay, and moves to a more dovish as opposed to hawkish policy, those are just fancy words for, are they constricting money supply or are they putting money supply into the market? If the Fed can move to a dovish money supply, which is putting money into the market, which is lowering interest rates, tech stocks and tech heavy industries should do well. Okay, that's just, we're just, just deductive reasoning basically. All right. The other thing that might most likely do well is consumer spending, because if there's a bull run, there is money to go around. Again, if interest rates come down, credit card loans, housing payments, car loans, personal finance loans, they all become less expensive. This means that people are going to be more comfortable spending money, especially when on top of that you look at the unemployment rate, which is very low. If we get a bull run and we get a growth in the economy, those numbers are going to remain low. So we're going to have unemployment at low rates, and we're going to have lower interest rates than what people have right now. That will push consumer spending up. So what companies do well when consumers spend? Well, consumer electronics do well. Luxury goods do well. So Apple, right? Apple is kind of in between both. It's kind of in between a consumer electronic and a luxury good, because they sell consumer electronics that are more expensive. So you want to start finding these companies that in a boom will do well, as opposed to more conservative based thinking. If we are not certain, or maybe you're watching this video and you're like, Derek, you're a fucking idiot. You're an idiot. We're not going to have a bull run in 2024. You're stupid. And I think we're actually going to have, we're going to have chaos. Okay. If you believe that, your portfolio is going to look a lot different, right? Because certain companies do better in those scenarios, right? So we're going to go more like dividend-based companies, companies that have been around for decades, if not centuries, Coca-Colas of the world, right? Companies that also do basically consumer necessities, right? So anybody that sells consumer necessities, not luxuries or products that you don't need to live with, those companies do well in a down market. So if you're looking at me and you're saying, Derek, you are stupid. You shouldn't have got your finance degree because it's fucking worthless. If you're in that camp, I respect your opinion. Your portfolio might look a lot different than mine, right? Your portfolio might be more conservative. You might continue to hold more bonds because you think interest rates are going to remain high. On the other side of the coin, if you do think that maybe there's going to be a bull run, we also have to talk about bonds, right? Because bonds do well in high interest rate environments, and bonds are also safer investments, right? So basically last year till now, I was a big advocate of bonds. Why? Because we were moving into higher interest rates, all right? And so for example, like I-bonds, because of inflation, those are tied directly to inflation. I own them still, and I will be liquidating them here soon, because the interest that they're paying on those are not as good anymore, because inflation is going, at least we believe, in the right direction. And bonds in general are like that. Remember, bonds are inversely correlated to interest rates. So as interest rates rise, bond prices come down, which makes them an attractive investment, because when interest rates start to come down, bond prices are going to go up, right? They're inversely correlated, all right? And I made a video on that. There's a reason for that. Basically, bonds have to compensate for a higher payout. So when interest rates go up, equal higher payout, the price of existing bonds have to come down. So as interest rates move down, those bonds that are owned currently should go up in value. But to purchase bonds later this year or into next year might not be the best bet, because interest rates are already too low. That's why last year, moving into this year, I've been a big advocate of bonds precisely for that. So bonds, again, tend to be a safer investment, and they should make us up a portion of your portfolio depending on your age and how close you are to retirement. Okay, now let's move to the other camp. So that camp is easy, right? It's well diversified for the most part, with a few ETFs that might be sector specific, okay? Sector specific to sectors that you believe will do good, either in a bull run if you're on the same page as me, or if you think I'm an idiot and I'm wrong, then sector specific companies or ETFs that track things like dividend aristocrats or established companies, right? The blue chips of the world, you might have more of those if you think that the market is not going to boom next year. So that's pretty straightforward. That's just good old personal finance 101, and that's good financial planning 101. What about the other camp, right? If you want to make outsized returns, well, you can do them with sector-specific ETFs. And in my opinion, that's still a safer bet than going and hand-picking stocks, because at least then you might have a higher percentage of your portfolio in sector-specific ETFs, okay? But and you're still going to get outsized returns as long as those sectors do well. But then, of course, there are those who want to hand-pick stocks. Now, I am not here to give you stock recommendations. I'm not here to tell you which stocks I think will do good or which stocks I think will do bad. All right? What I'm here to tell you is that the people who hand-pick stocks will have either higher returns or higher losses. So your conviction in regards to the market, if you're going to handpick your stocks, your conviction better be high. You better be certain about your bet, because you are putting real live money behind it when you invest in the market. So if you're going to handpick stocks, just understand that you need to, or you should understand the basics of fundamental analysis. You should understand the basics of discounted cash flows, and you should still understand the basics of macroeconomics. Not microeconomics, but macroeconomics, because you need to understand that macroeconomics affect the market. Okay? Think of it this way. Companies are like ships at sea. Okay? The sea is the market, and macroeconomics is the wind and the moon and the weather that affects the ocean. Okay? So when you look at it that way, you have to understand, if you are going to place your bet on this ship or this boat, you have to understand the way that the ocean, which is the market, will react, okay, to macroeconomic trends, which are wind patterns, the moon, tides, things of that nature, right? So when you look at it that way, you have to understand it always starts with macroeconomics, because no matter how well positioned a company is or how great the idea a company has, if the macroeconomics is not a suitable environment for that company to operate in, it will have trouble operating in that environment. So understand that. So if you're going to hand pick stocks, not only do you have to pick stocks that you think are fundamentally and financially strong and have good DCF prospects, discounted cash flows, and give you that they're selling at a value that is fair or below your valuation based on DCF. Not only do you have to do those things, but you have to look at the macroeconomics, and you have to have conviction that whatever you think is going to happen is going to happen. Because I am telling you my opinion. I am telling you that I think a bull run will take place in 2024, and I'm putting my cards in that camp, that side of the table. With that said, am I God? Absolutely not. Do I have a magic 8-ball? Absolutely not. Do I think that am I here to sit and be like, I'm so smart? Fuck no. Okay? I do not have a magic 8-ball, and I am only placing my bets based on my experience and my education and what I see taking place in the market. But I can be wrong, and I've been wrong in the past. All right? So if you're going to place a significant bet when it comes to picking individual stocks, like Apple, like Tesla, like, let's say, like the new up and coming players, right? Like Rivian or Lucid, which are up and coming players in the electric car market. If you're going to place a bet on those things, you better have conviction that that market is going to stay strong and only grow. And it does seem like that. But not only that, is Toyota going to come in and absolutely dominate? Is Ford going to come in and absolutely dominate? Are they going, no matter how good the idea of company X is, let's say Lucid or Rivian, no matter how good their cars are or how good their ideas are, is Ford and Toyota and Tesla, are they going to make it a suitable macroeconomic environment for those companies to operate in? Because no matter how good those ideas are, if larger companies just dominate the market, those other companies might struggle. Okay? So you have to look at, and that's for every industry across the board. You have to have conviction in your beliefs into what is going to happen in the market and in individual sectors. All right. So those are two camps to make money in the upcoming bull run. I believe that there is going to be one. We'll see if this video ages poorly. I've been wrong before. I'll be wrong in the future. It doesn't matter. Okay? Personal finance, good personal finance, is about accumulating multiple bets, right, and winning most of them. That's basically what it is. It's not about being right or wrong every single time. It's about accumulating multiple bets and winning most of them. All right. And you can do that by just following good quality personal finance and investing principles. And that's all I'm here to share is good quality personal finance and investing principles to try to spread knowledge in a sector that I think is lacking, which is personal finance. I think that this country does a terrible job with personal finance, and maybe there are, ulterior motives for not teaching that in school, and there probably is. But it blows my mind that we can learn about the powerhouse of the cell and history and not have a class in high school. Maybe it's different now, but when I went, there was no class for personal finance. There was no class unless you went to college for it, and that's what I did. So hopefully on this channel, you can kind of get like a mini finance degree just by me blabbering, and that's all that I can hope for, because I love personal finance, and I know it can be the difference, especially when you look at 5 or 10 years out. It can be the difference completely different. Your life could be completely different purely by understanding personal finance or not, especially when you say 5 or 10 years. Your life can be go in 2 completely different directions purely whether you understand personal finance or not. That can be the driving factor in many, many things. In the age that you retire, all right, in how financially well off you are. In many things, personal finance is that little thing that people either have or they don't. So I try to spread my knowledge with that. Like I said, I got my degree in finance. You don't have to. My name is Derek. I've been doing this for a decade, and I absolutely love this stuff, and I love to be able to share this with you guys. If you have any questions, please feel free to leave them in the comments. If you disagree with me and you think that we're going to go into a bear market, please. I love discussion, and like I said, I don't assume that I'm just right. I like to hear other perspectives, because you might work in the field, right? You might work in finance, or you might work in the electric car market. And you might say, this is actually happening, or this, and I don't have access to that knowledge, right? So I love talking. I love hearing multiple perspectives, and I don't have a chip on my fucking shoulder. I know that people can be right and people can be wrong, and that's not what it's about. It's about making the best personal finance decisions that you possibly can with the information in front of you. That's all that we can all do. But I guarantee you, if you do it time after time, day after day, month after month, year after year, it will be the difference in how well off you are in 5 years or 10 years. Doesn't matter your salary level. It doesn't matter where you live. Purely understanding personal finance is going to change the trajectory of your life, and it will make it better than it would have been otherwise. So I hope that I can share some of that knowledge with you. I hope that these videos are helpful. Sometimes I feel like I just come on here and I just blabber, and I do have other videos that are very structured and edited. But I'm out of the, I'm out of the office for the next week, so I didn't edit this video. I just wanted to, to get it ready so I can have it up on Tuesdays. Tuesdays we do new content here every single Tuesday, and I'll also usually do another video Wednesday, Thursday, Friday on a financial topic that's happening real time, right? What the Fed said, interest rates, things of that nature. I'll keep you guys updated, and I'll give you my perspective on that. So I'll have edited content as well as just having a conversation, because I'm sure you noticed, but this has been one take. There is no edits on this. It's just me having a conversation with you guys, because I think personal finance should be personal, right? Sometimes you just got to have a discussion. It doesn't have to be so prim and proper. You can just have a discussion. That's what this was. My name is Derek. Hopefully this was helpful. Hopefully I didn't ramble too much. Hopefully you got something out of this. Hopefully it inspired you to invest and to learn about personal finance, because that's what this is about learning personal finance and taking hold of your financial future. As always, I got my degree in finance, so you don't have to, and I will see you in the next video.